Look
or
look
not?
further back on that chart. Uh, Hyperbolic upsides always resolve to the downside.
Hmm.
When you see what the Canadians refer to as a hockey stick chart, you have to sell. You just have to sell.
Right.
For some reason, when the price of something doubles, it becomes more attractive to investors. Now, consumers are smart. If the price of a winter coat was to double, consumers would find some other way to stay warm. But for some reason, consumers of financial products prefer to overpay. I sold my silver for two reasons. The first was that chart. I knew that eventually, and eventually wouldn't be very long, not measured in years, but rather measured in weeks, that the chart would resolve to the downside. But I also sold because I bought my silver as a speculation. And that speculation was that 18 or $20 silver, which is the price I paid, reflected a market that was dominated by hate. People hated silver. They didn't dislike it, they hated it. If I was to come on your show 6 years ago and talk favorably about silver, the comments in the social media section would have been, "What a moron!" You know, this market's never worked. It's never going to work. All that kind of stuff. And I love hate. Fast forward to December of last year and January of this year, that hatred had all disappeared. So the reason I owned my silver went away, and the market was in melt up. Uh, so I sold. When I sold 80% of it. I sold the stuff that was easy to sell. Principally the Sprott Physical Silver Trust, which I could sell with the click of a mouse on the New York Stock Exchange.
Mm.
Am I buying silver yet? No, I'm not. There's not hate in the market yet. And the silver stocks are much better speculations than silver is itself. So my silver exposure in the market is in the silver stocks rather than in physical silver. I'm indirectly involved in silver because my bank, Battle Bank, is an active lender to holders of silver bullion. So rather than owning the silver directly, what I own is an equity interest in an institution that's facilitating the private ownership of silver. In that sense, I'm still fairly involved in the physical silver market.
How do you measure hate? How do you quantify hate or love in this case?
Well, for one, price. Anytime a commodity on a global basis is priced in world markets at less than the total cost to produce it, that industry is in liquidation, which is prima facie evidence of investor hatred. It's difficult in silver because only about 18% of primary silver supplies come from silver mines. The rest comes from recycling or byproduct production. But the truth is, at $20, we were well below the total cost of production of a silver mine. Not the all in sustaining cost, but rather the total cost, including cost of capital and social rents, taxation, and royalties. That's one reflection of hate. The other reflection of hate would be, as an example, if you posted this interview on YouTube and I looked in uh, the comments reflect market sentiment fairly accurately
They
if
do,
there
yeah.
is a preponderance on one side or the other. Danny, you remember that at one point in time, for a long time, I own and ran, and then ran for new owners, Sprott, a retail brokerage firm. And I walked in the cage almost every night. And anytime there was an overwhelming preponderance of sell tickets, I entered a buy ticket for something the next day. Anytime there was a preponderance of buy tickets, I entered a sell ticket every day. What I found is that anytime that there is an 80% or more um, market share of one belief, that you're wise to bet against it. When people express that preference in social media comments, they've already expressed that preference in the market, which is to say the primary momentum uh, behind the narrative of the moment has already dissipated. When people criticized me for owning silver 5 years ago or 6 years ago, they'd already sold their silver. That supply was psychological supply. It was gone. That's something that's taken me a long time to learn.
Oil is cheap in real terms. The world underinvested $1 billion a day in sustaining capital. A structural oil shortage is coming in 3 to 5 years. Rick Rule says every rational investor should have 10% in oil stocks. Gold priced in dollars is expensive, but priced in gold, everything is cheap. Housing at all-time lows in gold terms. The dollar will lose 75% of its purchasing power this decade, like the 1970s. Gold will maintain purchasing power. Silver? He sold 80% at the top. He's not buying yet. There's no hate in the market. Silver stocks are better than physical silver right now.
Or inspired shortage. Further to oil, though, Danny, and I think your audience needs to understand this. In conversations that you and I had a year ago, I talked about a supply shortage that I thought would begin in 2029 and 2030. Not war inspired, but rather a shortage that would occur as a consequence of deferred sustaining capital expenditure by oil companies around the globe. That picture has not changed. That picture hasn't changed whatsoever. And that is not a shortage that can be solved by armistice. On a global basis, mostly parastatals, but on a global basis, the oil industry is underinvesting in sustaining capital to the extent of $1 billion a day. You can get away with this for a couple of years, but after a while, that impairs your ability to produce. It's important to understand that. On top of the $1 billion a day in deferred sustaining capital investments, we blew up a whole bunch of capital in the Middle East that needs to be replaced. The Karg Island facilities of the Iranians, the facilities in the United Arab Emirates, in Qatar, in Saudi, and there was a greater hiatus in working capital expenditures, sustaining capital expenditures over the last 3 months. Why would you spend a bunch of money on sustaining capital investments when you need that money to fight a war? And why would you build stuff if the other side was going to blow it up? The upshot of all of this is that we just went through sort of a 3-month period of contrived scarcity, which is to say scarcity that was externally imposed via war. We're coming into a period, probably 3 years from now, of structural scarcity, of scarcity that's a consequence of deferred sustaining capital investment that won't be able to be solved except via price and via investment. That's a very important theme for investors to understand.
Puts things into perspective that
It
we may
puts
not have. Yeah, go
it
ahead.
puts many things in perspective. The big thinkers of the world, the Angela Merkels and the Greta Thunbergs and the Joe Bidens, the Justin Trudeaus, would have you believe that oil was a sunset industry, that by 2030 that we would have reached peak oil demand. That's just plain not true. It is simply not true. I'm 73 years of age. I don't think the peak oil demand will occur in my lifetime. It may not occur in yours, Danny. And that chart's very instructive. Assuming that global oil demand is even less than global aggregate economic growth, oil demand will continue to grow inexorably unless there's a real price shock. When the big thinkers look at that chart you just showed me, what they say is that it will be hollowed out by other sources of energy, particularly alternative energy. It's important to note that in the last 45 years, depending on which information you draw from, the world has invested between $6 and $11 trillion on alternative sources of supply. And although alternative energy supplies have increased and increased dramatically, though that alternative energy has reduced the market share of fossil fuels in power generation globally from a high of 83% 45 years ago to a low of 81% today, which is to say an investment of between $6 and $11 trillion has resulted in a 2% reduction in the market share of fossil fuels. Those are facts. They're not narrative. This isn't Greta Thunberg physics. This is just simple arithmetic. And if we have a situation where we extrapolate that line, even if we take that line flat, that graph you just showed,
Mm.
if you reduce supply by 4 or 5 million barrels a day as a consequence of systemic underinvestment in sustaining capital, you begin to need to ration oil by price. And that circumstance won't be ameliorated with an armistice.
Rick, how favorable are you to the oil sector right now, given all the other sectors that are also in play? Is it higher up on your
Uh,
favorability, or
yeah, it's much higher up because it's a better business and it's a bigger business. Uh, if you compare investing, if that's the right phrase, in junior mining shares, something I'm known for and something I enjoy, compared with investing in Exxon, those are very different circumstances.
Mm,
You can use money to buy Exxon that you're going to send a kid through school with or that you're going to retire on. That's not what you do in investing in consolidated moose pasture mines. Those are very different circumstances. I think there's more speculative upside in mining shares, even the big mining shares. But it's difficult for me to understand, very difficult for me to understand why any rational investor wouldn't have at least 10% of his portfolio in the oil stocks. I
mm.
just think over 5 years, absent a global depression, synchronized global depression, that the writing is on the wall. It was difficult for me 4 weeks ago to recommend the oil shares because they'd all done very well and the crude price was very high. I suspect in the next 90 to 120 days that the oil price perhaps drifts lower, but at any rate, the oil shares come off, completely discounting the inevitability of higher, at least higher nominal oil prices as scarcity and a declining US dollar uh, buoys the oil quote. I think that says two things. First of all, it says the commodities are actually cheap. It also, and I can't emphasize this enough, your listeners need to maintain in their own minds, at least, a gold standard, an accounting in gold. I've been saving primarily in gold while maintaining liquidity in US dollars. I've been saving primarily in gold since the year 2000. And I make myself informally do a sort of an account uh, of the real pricing of goods and services that I consume denominated in gold as opposed to in US dollars. If you do that, you're astonished by how cheap things are.
Mhm.
Uh, Most of my mind still thinks in dollars because that's what I spend. And when I go to a restaurant or when I go to the store, certainly when I pay my taxes, things seem nominally very expensive. And when I recast those expenditures in gold terms, things are really astonishingly cheap. I think it's important that people do this consciousness exercise for two reasons. One, to understand the perniciousness of the decline in the purchasing power of US dollars and the real rate of savings that you need to do as an individual to maintain your purchasing power over time. And secondly, to understand the efficacy of saving, at least partially, in gold. Those are two absolutely critical reasons why people need to adjust their thinking in terms of the maintenance of their purchasing power and their ability to provide for themselves and their families over the next 10 years.
Yeah, here's another good one. Here's housing prices. We're gonna pull one up here. Let's pull, where is it? Housing prices, nominally speaking, is U.S. single family homes all time high, or just about all time high. However, if you price this thing in gold, check this out, all time low. So U.S. single family homes priced in gold, uh, still here at the bottom, uh, pretty much on the same level as they were back in 2011, 2012, which was the nominal bottom as well. You see the high here from 2000 all the way up until 2005, price in gold. And you had another high here in 1970. So you have three bottoms here, and we're at the third one.
Right. I think that's a really, really, really important chart for your listeners to pay attention to. Shelter costs, energy costs, groceries are all political issues. The real issue is the deterioration in the purchasing power of our unit of exchange. It's the dollar. It
Mm.
isn't that housing has gone up. It's that your purchasing power, measured by uh, a floating abstraction called the US dollar, has gone down. If I'm right, Danny, and we've talked about this on your show before, if I'm right, the next 10 years will see approximately the same performance that the US dollar enjoyed, if that's the right phrase, in the decade of the 70s.